Welcome back to the channel. Today we are going to talk about one of the most important concepts in trading and investing, the stop loss. If there is one thing that separates successful traders from unsuccessful ones, it is discipline around risk management. And the stop loss is the single most important risk management tool available to any trader or investor. By the end of this video, you will understand exactly what a stop loss is, why it is absolutely essential, and how to use it correctly. Let us get started. A stop loss is simply a predetermined price level at which you decide to exit a trade if it moves against you in order to limit your loss. When you buy a stock, you are hoping it will go up, but markets do not always cooperate. Sometimes a stock goes down after you buy it. Without a stop loss, you might hold on hoping it will come back and watch a small loss turn into a devastating one. A stop loss prevents this from happening. You decide in advance, before you enter the trade, exactly how much you are willing to lose. If the stock reaches that level, your position is automatically or manually closed and your loss is capped at the amount you decided. Think of a stop loss as an insurance policy for your trade. You pay a small premium, accepting a small loss, to protect yourself from a much larger catastrophic loss. Let me give you a simple example to show why stop loss is so essential. Imagine you buy a stock at 1000 rupees. Without a stop loss, the stock falls to 500 rupees, a loss of 50%. To recover from a 50% loss, you now need the stock to go up 100% just to break even. That is an enormous hole to climb out of. But if you had placed a stop loss at 900 rupees, a 10% loss, you would have exited with a manageable loss and preserved 90% of your capital to invest in better opportunities. This is the fundamental logic behind stop losses. Protect your capital so you can continue trading another day. Professional traders have a saying, take care of your losses and the profits will take care of themselves. No single trade should ever be allowed to do serious damage to your overall portfolio. The most important question is, where exactly should you place your stop loss? There are several practical methods. The most logical and widely used method is to place your stop loss just below a key support level. If you buy a stock near a support level, your stop loss goes just below that support. The logic is simple. If the support level breaks, it means your reason for buying the stock is no longer valid and you should exit. Similarly, if you are shorting a stock near a resistance level, your stop loss goes just above that resistance. Another method is the percentage-based stop loss, where you decide in advance to exit if the stock moves against you by a fixed percentage, say 5 or 7%. This is simpler but less precise than placing stops at key technical levels. A third method used by many traders is the ATR-based stop loss, where the stop is placed a certain multiple of the average true range away from the entry price. This automatically accounts for the volatility of the specific stock. Section 4. Common stop loss mistakes. Let me quickly cover the most common mistakes beginners make with stop losses. The first and most dangerous mistake is not using a stop loss at all. There is absolutely no excuse for this. Always use a stop loss on every single trade without exception. The second mistake is placing the stop loss too tight, so close to the entry price that normal market fluctuations trigger it before the trade has a chance to work. Give your stop loss enough room to breathe based on the stock's normal volatility. The third mistake is moving the stop loss further away when the trade goes against you, hoping the stock will come back. This completely defeats the purpose of having a stop loss and is how small losses become catastrophic ones. Once you set a stop loss, never move it in the direction of increasing your loss. You can move it in the direction of protecting your profit. This is called a trailing stop loss, but never in the direction of increasing your risk. To summarize, a stop loss is a predetermined exit point that limits your loss on any trade. It is the single most important risk management tool in trading. Place your stop loss at logical technical levels, just below support when buying and just above resistance when shorting. My chartinin Keng. Never trade without a stop loss, never place it too tight, and never move it to increase your risk. The traders who survive and thrive in the long run are not the ones who never have losing trades. Everyone has losing trades. They are the ones who keep their losses small and let their profits run. Master the stop loss, and you will have taken the most important step toward becoming a disciplined and successful trader. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.